Most silver investors believe their biggest challenge is figuring out where silver prices are headed next. They spend countless hours analyzing inflation reports, central bank policies, mining production, industrial demand, and economic forecasts. They watch experts debate whether silver is about to explode higher or suffer another major correction. But there is one threat that receives far less attention, a threat that has surprised thousands of investors, a threat that can quietly take a significant portion of your profits, even if your investment thesis turns out to be completely correct. It's called the silver tax trap, and for many investors, the discovery comes at the worst possible moment, not when they're buying, not when they're holding, but when they're finally ready to cash in years of gains. By then, the damage may already be done. Think about that for a second. Imagine spending years building a silver position. Imagine ignoring short-term noise. Imagine holding through market volatility. Imagine staying patient while others lose faith. Then imagine silver finally surges higher. Your portfolio grows. Your investment strategy appears validated. Everything seems to be working exactly as planned. And then, an unexpected tax bill arrives. Suddenly, a large percentage of those gains disappears. The profit you thought belonged to you is much smaller than expected. And the most frustrating part is that nothing actually went wrong with the investment itself. The silver performed exactly as you hoped, yet you still lose a substantial portion of your gains. That's why understanding this topic is so important, because the silver tax trap doesn't punish bad investors. In many cases, it punishes successful ones. If you enjoy uncovering hidden truths about silver and gold, make sure to like this video and subscribe to Gold and Silver Intelligence, because today we're exploring one of the most overlooked risks in precious metals investing. Now, most people assume taxes are something to think about later. After all, the first goal is making money, the second goal is keeping it. Unfortunately, many investors spend years focusing on the first goal and almost no time focusing on the second. That creates a dangerous blind spot. Because wealth accumulation and wealth preservation are not the same thing. Building wealth requires one set of skills. Protecting wealth requires another. And many investors don't realize that until it's too late. Here's where things get interesting. Let's imagine two investors. Investor number one buys silver and holds it for years. Investor number two does exactly the same thing. Both eventually earn a substantial profit. Both made smart decisions. Both exercised patience. Both took similar risks. Yet one investor ends up keeping significantly more of the profit. Why? The answer has very little to do with silver itself. Instead, it comes down to planning, preparation, documentation, and understanding rules that many investors completely ignore. Now here's the detail most people miss. When people think about investing, they focus almost entirely on returns. How much can I make? How high can prices go? How much profit will I earn? But experienced investors ask a different question. How much of that profit will I actually keep? That may sound like a simple distinction, but it changes everything. Because a profit that exists only on paper is very different from a profit that remains in your bank account after every obligation has been paid. And that's where the silver tax trap begins. At first glance, silver appears straightforward. You buy it, you store it, you wait, you sell it later. Simple. But reality is much more complicated. Every investment exists within a larger system. That system includes regulations, reporting requirements, documentation standards, tax obligations, and legal classifications. Ignoring those factors can create expensive surprises. What happened next changed the way many investors viewed precious metals entirely. As silver investing became more popular, millions of people entered the market seeking protection against inflation and economic uncertainty. Some purchased silver coins, others bought bars, some invested through dealers, others purchased through online platforms. Many accumulated their holdings gradually over years, a few ounces here, a few ounces there. Another purchase during a market dip, another during a period of economic concern. At the time, these purchases seemed simple. But years later, many investors discovered that tracking everything accurately was far more difficult than expected. Purchase receipts were lost, records were incomplete, transaction details were forgotten, and when it came time to calculate gains, uncertainty created problems. That alone would be important, but something else happened. Inflation began changing the financial landscape, and this created one of the most misunderstood aspects of precious metals investing. Let's say silver doubles in price over a period of years. Most investors immediately view that as a huge victory, and in many ways it is. But here's the question few people ask. How much of that increase represents real wealth creation? and how much simply reflects a decline in the purchasing power of currency. This distinction matters more than most people realize, because inflation can create the appearance of profits that are larger than the actual increase in purchasing power. In other words, some of the gain may simply be preserving wealth rather than creating new wealth. Now here's where the situation becomes fascinating. Imagine inflation rises significantly over several years. The price of goods increases, housing becomes more expensive, energy costs rise, food prices climb. At the same time, silver prices move higher. An investor sees a substantial gain. But after adjusting for inflation, the increase in real purchasing power may be much smaller than it first appears. Yet taxes are often calculated on the gain itself, not necessarily on the investor's perception of real wealth preservation. This creates a contradiction that surprises many people. An investor may feel they simply protected purchasing power. The tax system may view the situation very differently. Now, whether someone agrees or disagrees with that reality is a separate discussion. The important point is understanding that the distinction exists, because investors who fail to recognize it may underestimate the impact taxes can have on long-term returns. And that's exactly what makes the silver tax trap so dangerous. It hides behind assumptions. Most people assume a profit is a profit. Most people assume gains automatically translate into increased wealth. Most people assume successful investing ends when the asset appreciates. But successful investing doesn't end there. That's where another phase begins, the wealth preservation phase. And this is where experienced investors often separate themselves from beginners. Because experienced investors understand something critical. Making money and keeping money are two different challenges. Many people can make money during favorable market conditions. Far fewer can preserve it effectively over decades. That lesson extends far beyond silver. It applies to stocks, real estate, businesses, and virtually every asset class. Now let's zoom out and look at the bigger picture. Why are so many people interested in silver in the first place? The answer reveals why this topic matters so much. Silver occupies a unique position in the financial world. It is both a precious metal and an industrial metal. It has monetary history stretching back thousands of years, yet it also plays an important role in modern technology. This combination makes silver different from many other investments. Some investors see it as insurance, others view it as speculation. Some consider it protection against inflation. Others believe industrial demand could drive future price increases. Regardless of which argument proves correct, one reality remains unchanged. If silver appreciates significantly, tax planning becomes increasingly important. The larger the gain, the greater the potential impact. And that's where many investors find themselves facing difficult decisions. Do they sell immediately? Do they wait longer? Do they restructure their holdings? Do they seek professional guidance? These questions become more important as positions grow larger, and yet many investors don't think about them until the last possible moment. Now here's the detail most people never consider. Taxes don't just affect outcomes, they affect behavior. Think about what happens during a major bull market. Prices rise rapidly, excitement spreads, media coverage increases. New investors enter the market. Veteran investors see significant gains. At that point, many investors begin considering whether to sell, but taxes become part of the equation. For some investors, tax considerations influence timing decisions. For others, they affect position sizes. And for some, they determine whether they sell at all. This means tax policy doesn't simply affect individual investors. It can influence broader market behavior. And when enough people respond to similar incentives, entire markets can be affected. That alone would be a remarkable observation. But the story gets even bigger. Because governments around the world are paying closer attention than ever to financial transactions. Reporting requirements continue evolving. Record-keeping expectations remain important. Documentation matters. Accuracy matters. Compliance matters. For investors, this means organization becomes increasingly valuable. The days of casually ignoring records are becoming less practical. The investors who maintain detailed documentation often place themselves in a stronger position later. The investors who don't may face complications when they least expect them. And this brings us to one of the most important lessons in all of investing. Preparation creates flexibility. The more prepared an investor is, the more options they typically have. The less prepared they are, the fewer options remain. This principle applies everywhere, not just in silver, not just in precious metals, but throughout finance itself. The investors who think ahead usually place themselves in a better position than those who react after problems appear. Now let's consider the future. Many analysts believe silver could experience significant volatility in the years ahead. Some expect stronger industrial demand. Others anticipate economic uncertainty. Some believe inflationary pressures could remain important. Others focus on long-term supply challenges. No one knows exactly what will happen. But one thing is certain. If silver prices move substantially higher, millions of investors will eventually face decisions about selling. And when that moment arrives, tax planning will become more important than ever. That's why understanding the silver tax trap today matters. Not because you're necessarily selling tomorrow, but because preparation works best before decisions become urgent. The biggest financial mistakes often occur when people are forced to make important decisions under pressure. The best decisions are usually made long before pressure arrives. And that's exactly why successful investors spend so much time preparing. Now I'd like to hear from you. Do you think taxes play a larger role in investment outcomes than most people realize? Or do you believe investors focus too much on taxes and not enough on asset selection? Leave your thoughts in the comments below. These discussions often reveal perspectives that many investors never consider. As we wrap up, it's important to remember the larger lesson. The silver tax trap is not really about taxes. It's about awareness. It's about understanding that investing involves more than choosing the right asset. It involves understanding the entire environment surrounding that asset, the rules, the obligations, the opportunities, the risks, and the consequences. The investors who succeed over the long term are rarely the ones who know only one piece of the puzzle. They're the ones who understand how the pieces fit together. Silver can be a powerful tool. Gold can be a powerful tool. But tools alone do not create successful outcomes. Knowledge does. Preparation does. Discipline does. And perhaps most importantly, awareness does. Because the greatest financial risks are often the ones investors never see coming. And by the time they become visible, it may already be too late to avoid them. So the next time someone tells you that successful investing is simply about buying low and selling high, remember this. The real goal is not just making money. The real goal is keeping as much of that money as possible. And that may be the most important investment lesson of all.